example, I can't come up with a conclusion that in the next few years, platinum's going to go berserk more than gold. No, I can't do that. It may, has its own unique fundamentals. The one I do think will go berserk relative to gold is silver. The Fed was founded over 100 years ago. We've undergone boom-bust cycles in the stock market. And you've undergone, if you'll look at the data from the Fed, like Fed funds rate chart, go back 50, 60 years, or M2 growth, We've been through boom-bust cycles on the monetary side, which has helped fuel many asset categories from time to time. Much of the time, especially if the stock market's been beaten up after the bust of a prior bubble, it'll turn up again when they re-stimulate the economy with lower than reality interest rates, for example. Well, we've certainly undergone that since 2009. About 10 of the last 15 years, we've had free rates, Fed funds. And money growth has been more than it is in any other 10 or 15 year period. It's also, M2 is growing. So you have a degradation of the money, but investors ultimately are the ones who allocate that river flow of liquidity. And back in 2009, it was justified technically. In fact, we said so. We said this is a major low. The Fed was pumping money, and at that point, it worked. In other words, 2007, they started pumping and cutting rates at the top. 1 month before the top, they started cutting rates sharply, and it didn't help. The market collapsed. 50% drop in the S&P. They did similar stuff 2000 to 2002, yet NASDAQ 100 dropped 82%. So there's times when they create the money flow, it doesn't help the thing they want to help. And right now, I think we're in a super bubble situation. In several major stock indices, US, Japan, India. Those three, the Sensex, the Nikkei, and the S&P, and the NASDAQ 100 especially, compared to the Shanghai composite, for example, which is not a bubble. It had a bubble period, but it broke. It's not even, I think it's trading about double where it was in 2009. Well, S&P is trading about 8 times higher than 2009. NASDAQ 100 about 18 times higher than 2009. And plus the bull trends weren't like 4 or 5 years, which they normally are. 23 to 29, 94 to 2000, 6 years, 2009 low, but that's 15 years. There's a time difference and a multiple difference. And when you look at an M2 chart and you look at a Fed funds rate chart, you see why. Highly abnormal monetary policy. When that bubble breaks, and it will have its own reality way above and beyond the power of the Fed. It's always been the case at major tops. Whether the Fed cuts rates or not, it doesn't matter. When that bubble breaks, it breaks. The problem is this bubble has so many embedded errors in it. And now we know that the debt error included in this is not just home mortgages like in 2007, 8, and 9. It's government debt. U.S. government debt in particular. It's off the page disaster waiting to happen. Central banks, not just us, but other central banks, Japan, Europe, etc., are a club, and they'll move together. They may deviate a little bit here and there, but they'll move as a group. And they will act aggressively to try to defend the breaking of these bubbles. That money flow will go somewhere. And we're betting it will go where it normally does. Gold. You go back, 1930s, for example, when the stock market imploded, home stake mining, you couldn't buy gold. Home stake mining went up 1,000%. Okay. And it's similar 2000, 2002, 7 to 9, et cetera. So it's different this time. It's bigger than any prior gold bull dynamics. Our view of platinum is we use the term precious metal, palladium as well. We use the term monetary metal for silver and gold, okay? And there's a reason for the differentiation, which I'm sure you understand. Platinum, if you'll study it, we also are looking at the Bloomberg Commodity Index, for example, as an asset class. And it has been moving inversely to the stock market for some years now, and it's done that before the other way, on the upside. During periods of time like from 2000 to 2009 to 2013, in fact, the S&P was in a range. It made a high in the mid-1500s in 2000, came back to the mid-1500s in 2008, 2007, And it wasn't until 2013 it finally got out of that nominal range. So you finally began making money again. During that time, commodities were going up, okay? And even during periods where we have a so-called recession, like in the late 70s, the stagflation, remember that? Commodities were going berserk on the upside, so don't mix too many false notions in there. Right now, the Bloomberg looks poised to follow gold. It has not followed gold during the period from 2015 to 2020. Bloomberg went down. Not a lot. It had already collapsed, but it continued to edge down while gold doubled. So there wasn't a good linkage. But right now, the technicals look like in this phase of the gold advance and the silver advance, expect broad commodity complex to join in. And it's an asset category that has both low risk and high reward, and stocks related thereto. Uranium producing stocks, copper producing, agricultural related, fertilizer companies, etc. They don't correlate well to the stock market. They do correlate well to the Bloomberg. Platinum is almost an overlay of the Bloomberg. It is behaving not like gold. It has been behaving for quite a few years now like the Bloomberg Commodity Index. So I can't come up with a conclusion that in the next few years, platinum's going to go berserk more than gold. No, I can't do that. It may, has its own unique fundamentals. The one I do think will go berserk relative to gold is silver. Okay, we know it's vastly undervalued to gold in terms of spread relationships, and we plot these in our reports and update them. We also know that gold and silver miners are vastly underpriced in relation to the ounce of gold and in relation to the S&P 500, for example. So as a category, both silver to gold looks cheap and ripe to go up many more multiples than gold will. By the way, this happened in the late 70s, 79 to 80, in the tail end of that bull market. Gold went up dramatically. Silver went up like fivefold compared to gold, okay? And it did it in the final year of that bull market. So it's not unusual. Similarly, it happened in 2010, in the final year or so, that 2010-11 peak, where gold peaked at 11, late in October 2011. Silver peaked in March of 2011, but silver went more berserk in the final several quarters of that move than did gold. It was like a white knuckle flight. I think we're going to have the same thing now with silver compared to gold. Gold is the mama, but silver is the wild dog on a leash. Okay, you know what I'm talking about. Okay, and that dog sometimes will run behind, as it did recently in the recent drop, and then there'll be times when it runs ahead. And I think we're about at that phase now where in the next leg up that we're about to commence in our assessment, because we've been in this, gold's been in a triangular congestion zone for now 3 or 4 months, okay? 2,800 high, 2,540 low, and twisting back and forth. Silver's had an erosional pullback from 35 into 29s. Now it's above 31 again. This next upsurge that we're about to see, and I'm talking now short to intermediate term, this next upsurge is likely to ignite that phase of the bull market where silver then dramatically outpaces gold. And probably also, if you wobble the stock market, you crack that bubble just enough to cause some fear and nervousness. Not a lot. You don't have to crash or anything. You'll get some monetary, you'll get asset movement out of that category. And our bet is one of the places it's going to go is in the tiny little gold and silver mining sector, to where it will tend to go on a percent basis berserk. So that's where I think we are right now, literally, as we're talking. We're in that, near that phase. The movement of the so-called dollar index is a waste of time if you're a gold investor. For example, if you go back to the December 2015, gold was $1,050. Okay, it's well more than doubled. Okay, dollar index then was trading around 97. Right now it's trading about 109, so it's gone up 9 or 10%. Okay, well, if you looked at the dollar index, you said, well, gee, I don't want to buy gold because it's going to go up 10% next 11 years. Okay, well, it did. Gold doubled and then some. Okay, so it didn't correlate well. Sometimes it correlates a little bit here and there. You might see it. But the main thing that's driving the dollar index right now is the relative rates, especially at the long end. Our rates being a little chokingly higher than certain other rates. Okay, now that could change dramatically, and we think it could, like the rally we may be seeing right now in the bonds, the longer end of the market, the end that the Fed doesn't control, could in part be initial movement of assets out of the stock market by certain asset managers who are becoming doubtful of the stock market, looking for a better or a safer place to be, at least temporarily. And if you go back and look at history from 2000, 2002, big bear market stocks, 2007 to 9, big bear market. During those periods, T-bonds and gold went up, okay? So they are alternatives. The difference this time is that T-bonds are in a major long-term annual momentum downtrend in price, upward in yield. We think there could be a temporary counter-trend move in T-bonds, meaning you do get a drop in rates. Maybe we're starting to see it right now. That's not because there's virtue in the T-bonds. It's because there's a perception of risk in the stock market. The money is seeking other places to be. Some asset managers will naturally go to T-bonds, knee-jerk. The one that's really beating the stock market is gold. Nobody knows that hardly, but year to year, last year, gold beat stock market. You go back to the about 2015 or early again in the 2020s, gold is higher on a relative basis than the stock market. So it's actually gained ground, not a perceptible amount, you can't beat the table over it, but it's actually been a better place to be. And yet nobody's pounding the table over it. I think those dynamics that people, trading short term and wanting money now is an indication of an underlying fear of uncertainty, a fear. I got to have it now. Can I have it now? There's no calmness out there. Even on the upside, it's not calm. It's not confidence. It's fear that's causing the buying. And sooner or later, it'll cause selling too. But I think there is an underlying fear. And then you talk about the geopolitical